Let's take a look at a question where a bond is issued at a premium. Looking Good Limited issues $1 million of 9% bonds on September 1st, 2020 for $1,058,671. The term of the bonds is September 1st, 2020 to September 1st, 2028, with interest payable quarterly each December 1st, March 1st, June 1st, and September 1st. The company uses the effective interest method with an effective rate of 8%. Prepare the company's journal entry for the September 1st issuance, the December 1st, and the December 1st interest payment. And we're given a part 2 as well, which we'll deal with in a little bit. Okay, so what do we know here? So we know that the bonds have a face value of $1 million, and we know that they were sold for over $1 million. So we know that they were sold for a premium. So we know we're going to need to amortize that premium, and we're also specifically told that they use the effective interest method. So we know we're going to need to set up an amortization schedule to amortize that premium using the effective interest method. So let's just start with one thing at a time. So the first thing we're asked to do is prepare the journal entry for the September 1st issuance. So let's start with that. September 1st, is it 2020 issuance? Issuance. All right, so we know we're going to have debit cash and credit bonds payable. So the company is going to receive cash for issuing these bonds. That's the whole reason that they're doing it. And they're going to have a long-term liability on their statement of financial position, because at the maturity of these bonds on September 1st, 2028, they're going to have to pay back the bondholders the face value of the bonds, or the $1 million. So we know that, and we know that's going to be a long-term liability because it's not due within the next year or operating cycle of the business. So we know it's going to be long-term. So what cash are they going to receive here? Is it going to be the million, or is it going to be the $1,058,771? Well, the cash that's going to change hands is going to be the present value of the bonds. And in this case, we're told what the present value is because we're told what the cash is that exchanged hands. And that is this 1,058,671. So that is the amount that the company received for the bonds. So that's the cash they're going to receive, and that's the liability that's initially going to go into their statement of financial position. And like we said, over time, we're going to amortize this liability down for the bond payable, and we're going to need it to be the face value at maturity of the bonds on September 1st, 2028. We need that to be exactly $1 million because that's what we're going to owe back. Okay, so next we're asked to record the journal entries for the next interest payment. Okay, so we've got, this thing is not cooperating here. Okay, so we've got for the December 1st interest payment is the one entry that we're asked to do. So let's just set up an amortization schedule here quickly. So we're going to have date of each payment. We're going to have the cash paid, which is going to be the face value times the stated rate. Then we're going to have the interest expense, which is going to be the carrying value times the market rate. And then we're going to have the premium amortized. And then we're going to have the carrying value. So we know that on September 1st, the issuance of the bonds, we don't have any cash paid or interest expense or premium to amortize. We simply know the carrying value of the bonds, which was 1,058,671. The next payment, which is going to be December 1st, we're only asked to go this far, which is perfect, December 1st, 2020. So we need to know what the cash is going to be paid. We need to know these amounts in this table so that we can prepare a journal entry. So the cash paid on the bonds is going to be the face value of the bonds, which is going to be 1 million, times the stated rate. So in this question, it says that the bonds pay out interest at 9%. So we've got 9%. And then this is really important. We need to think about how often these interest payments are going to take place, because if we just took 1,000,000 times 9%, that would give us our annual payment that we would make to our bondholders. But we're told that we make this payment 4 times a year. I think this is one of the first questions we've seen where it hasn't just been semi-annual. Now the payment is quarterly. So now we're going to need to multiply this by 1/4. Okay, and that is going to give us 22,500 per quarter. So that's going to be the cash that we're paying out here. Our interest expense is going to be the carrying value of the bonds times the market rate. So we're told that in the question that the market rate was 8%. So here we're going to have 1,058,671 times 8%, and then also times the quarter, because these payments are quarterly. And that's going to give us 21,173. And that's what we're going to put into our question here. And the difference between these two things is going to be the amortization of our premium. So 22,500 minus 21,173 is going to give us 1,327. And then we can just intuitively figure out if we're adding or subtracting to this value. So we know that over the next, 5 years, 8 years, 8 years, we're going to be amortizing this premium through. And at the end of the maturity of the bonds, we need this amount to be at 1,000,000. So we know we need to be deducting from the carrying value. So we know that this premium is going to reduce the bond value. So if we take 1,058,671 and subtract 1,327, we're going to get 1,057,344 as our new carrying value. We don't necessarily need that to answer this exact question, but it's helpful because if we had to keep continuing the payments through, if it asked us for the next interest payment, then we would need that carrying value to figure out what the interest expense is, because the interest expense uses the carrying value times the market rate. Okay, so then our journal entry is going to be, let's put it right here, we're going to have debit interest expense. This is our December 1st payment. Okay, debit interest expense. So that's going to go through our income statement. Then we're going to need to debit the bond payable because we're decreasing the liability. We need to bring it closer to the million. So this is a debit, the opposite of the liability on our balance sheet, which is a credit, to decrease it. And then the credit here is going to go to cash. Okay, so if we look up at this table, the cash that we know we have to pay out to the bondholders is going to be 22,500. That's what they expect for the bonds. It said it's a $1 million bond that pays out interest at 9% quarterly. So they expect 22,500, and that is what we will pay out. We know that our amortization of the bond payable on the debit side here is going to be 1,327. And our interest expense was the sum of those two, which is going to be 21,173. So that is our journal entry for the December payment using the effective interest method. The reason that we go to the trouble of setting up this table here is because we know we can pick out the amounts for the journal entries straight from the table, and we can take this as far as we need to go without getting confused as to how the change in the carrying value is going to impact the interest expense. All right, let's take a look. So that took us through part 1. We did the journal entry for the issuance, and we did the December 1st interest payment entry. Part 2 says, assume the same information above, but assume the company reports under ASPE and uses the straight line method. Record the journal entries. Okay, so let's take a look. So if we were reporting under ASPE, let's just change our color here so we're thinking ASPE. So if we were reporting under ASPE, this journal entry would be the same. There's no change to the present value of the bond or what cash changes hands, and we still debit cash and credit the bond payable to set up the liability. So that's not different under ASPE. What would change is the way that we amortize the premium. So we know that under ASPE, what's going to happen under ASPE is that we would say, okay, so we paid a premium of, we had $1 million bond. So ASPE, would say we had $1 million bond, and we paid 1,058,671. So there's a premium of 58,671, the difference between those two. So this is our premium. And we know that we need to amortize this through. We're going to amortize this over 8 years semi-annually. For 8 years semi-annually, which is going to be, so if we take that amount here, so if we take this divided by 8 years, and then divided by this amount divided by 8 years, and then divide this by 25%, say, per quarter, or 1/4, whichever way you want to do it. That's going to give us amortization of 1,833 per quarter. So you can see this is going to simply be 1,833 every single quarter. It's never going to change, whereas our amortization here would change each quarter based on the carrying value using the effective interest method. So in this case, our entry is going to be the same entry. The debits and credits don't change. So we've got debit interest expense. We still have a debit to bond payable, because no matter which method we're using, if we're using the effective interest method or if we're using the straight line method, we're still going to need to either increase or decrease the value of that bond on our balance sheet so that we get it at the face value at maturity. And then our credit is going to be to cash. So we know the bondholders need to receive $22,500. It's still $1 million bond, and it still pays out interest at 9% quarterly. So the bondholders are going to record $22,500. Doesn't matter which method we're using. They're going to receive that. Then we're going to have this amortization. So we know that we're going to be decreasing the bond in this case because the bond's on our balance sheet higher than $1 million. So we need to bring it down. We're going to be recognizing that every quarter. And then the difference is simply going to be our interest expense. So this is going to be $20,667 to balance that entry, simply the difference between those two. And this is our December 1st interest payment. ASPE, or the straight line method. This entry would be the same every single quarter. If it was an adjusting entry where the payment wasn't actually going to be made, then we would have an interest payable line here instead of cash. That concludes part 2 of this question.